Let's try to map all this in terms of the Fusion module. In the Fusion module, we have general ledger where we are going to enter the journals. All the journals, all the financial transactions will be recording in general ledger. Then we have some modules which are known as subledgers. That is where the actual transactions takes place. So we have payables module where we'll keep track of invoices that have to be paid to vendors, payments that have to be sent to invoices that we receive from the vendors or the suppliers, payments that we are going to make to the vendors or the suppliers for the goods or service that they have given. Receivables is to keep track of invoices. Receipts is to record what you have received from the customer. Cash management is for tracking bank accounts, statements, balances. Fixed assets is to keep track of fixed assets like laptop, computers, furniture, etc. Purchasing module is to keep track of purchasing process. Order management is to keep track of sales order. Subledgers generate the accounting entries that have to be sent to GL every month, every period. So what we do, we enter the transactions in the subledger. So somebody went and bought a computer, somebody went and paid a vendor. So that will be recorded in the subledger. Against that, we'll run a process by which the debit and the credit entries will be generated and they will be transferred over to GL. In GL, we'll be able to see the books of account. The total debit credit net figure we'll be able to generate. Now, in the application, there is always two parts where one side we have vendors or suppliers who are interacting with our enterprise. So anybody who is supplying goods or service is known as a vendor. Vendor will send the bills or the invoice for their goods or service that has been given by them. Vendor supplier will then can upload it also in the system. Then the payments will be enterprise will pay the payment to the vendor or supplier. This cycle is called as the procure to pay. Procure to pay. That means you're procuring something and you're paying for that. All the transactions that happen in between are recorded in the subledger, which is the payables module. Interaction between payables, cash management, and sometimes assets, other modules which are interlinked. Ultimately, they go and update the finance module, the general ledger, sorry. All this financial data will be transferred over to GL. On the other side, the customer facing side, you have two main entities. Again, where is the enterprise, that is ourselves, company which is doing the transaction, and the customers. For example, we are all Jio or Airtel or Vodafone customers, right? We are their customers. Or look at the banks with whom you have a credit card. End of the month, end of the billing cycle, they will send you an invoice saying you need to pay us such and such amount. Right? So that is the customer. So the enterprise is selling the goods or service to the customer. So they will send a bill to the customer. Customer will pay for that. That will be recorded as a receipt saying that we have received such and such amount from you. You meaning the customer. Now there are ways to load the volume. Like when you have a high volume of transactions, you don't always enter them manually in the application. You have processes to upload all that into the application. For example, you can upload a invoice, you can upload a receipt, you can upload a customer, You can upload a supplier. So there are tools like HDL or FBDI or HSDLI or your the APIs which are there to upload these mass huge. If there are huge volume of transactions, you can then upload them into the application. Clear? So this cycle is known as order to cash. Order to cash. This is procure to pay. I have shared with you an elaborate document which is talking about the procure to pay cycle. And this is the order to cash cycle. So what kind of modules are involved? When we say procure to pay module, then there are modules like purchasing. That is where the first step of the procure to pay happens, that you raise a requisition. Requisition is a need, request for a certain item. Like when you joined your organization for the first time, there was a request for a laptop or a desktop for you, right? When the request was made, whether it was by your manager or by yourself, you said that I need a laptop, I need a desktop, or I need something on which I'm going to work. That request went to the IT team. IT team looked at their stock. If they have that stock, they will give it to you. If they don't have a stock, they will then send it out to the vendors asking for a quotation. So the best price that is received by the company, they will place an order. Once the order is placed, they will get the laptop or the desktop, which is the invoice. They will send you the invoice. In case of companies, you don't always pay the amount immediately. You take certain time, maybe 15, 20 days, 30 days to pay that amount. And then that is recorded either in the bank directly. If they send it out from the bank, you will have the payment recorded. That payment will take the balance from your bank account and pay it to the supplier. So that bank management part is done in cash management. And all this purchasing, payables, all of them are connected with general ledger. Order to cash, there is order management. There you have customers. When you sell a good, or when you sell an item, sell a service, you send an invoice to the supplier, to the customer, sorry. You send it to the customer. Based on your payment terms, customer will pay you. If it is a business, they, or like we are individuals, in case of Airtel or Vodafone or Jio, they send us a bill. If it is a postpaid, if it is a prepaid, you have to pay first. But for your landlines, or for your broadband, or for your postpay charges, you have to pay up. And they give you certain days, 15 days, 2 weeks, 10 days, and within that you need to pay up. Okay. Now let us understand these accounting entries a little more. Let's say there was a small company which was operating out of, let's say, Delhi, Bombay, some location. So they bought an item, they bought some furniture for 4,000 rupees, and they paid it from the HDFC bank account. So you enter the record like this: purchase account debit. Debit what comes in. So you have got your furniture. Maybe you will have a furniture account. You will say furniture account debit 4,000 to bank 4,000. What is the account code? 1010. So every account that we have is recorded as an account code. So you will have like 10101, which is the purchase account. So in the application, you will find this entry 10101 account debit to HDFC Bank will also have an account code. This HDFC Bank will be called as a description of 11002. So we'll say 10101 account debit to 11002 account. Very good. Now the company is growing, so they open another account with State Bank of India. They purchase some more items, so now it is 8,000. So they decide, okay, 4,000 will pay from HDFC Bank account, 4,000 will pay from SBI Bank account. So 10101 account debit 8,000 to 11002 account 4,000, 11003 account 4,000. So 4,000, 4,000 becomes 8,000. Clear? Now the company expanded. So they opened another branch in Mumbai. So it was now important to segregate each transaction between Bombay and Delhi. So we'll have a location code. Delhi will be 11, Mumbai will be 12. All locations will say as 00. That means it will indicate all locations like a parent. That is called as a parent. These are the child location codes. Then Mumbai purchase account debit 8,000. So they paid from the Mumbai HDFC Bank 4,000, Mumbai SBI Bank 4,000. So if you reflect that in the application, it will become like this 12.10101 to 12.11002, 12.11003. So this structure that you see here, 12 is the location and this is the account code. This is your key flex field structure, accounting flex field structure that you will define in the application. So if the company now has two business units, one is hardware, one is software, 101 is the hardware, 102 is the software, you can have a chart of accounts which will have four segments. One is company, 01. Let's say there is only one company. Tomorrow, if they start another company, it will become 02. Business unit, 101, 102. Location, 10, 12. Account, 10101, 10102. So chart of account combination will look like this. This is the entire account code. It is not individually. Remember this. This entire combination is your one account code. So when you enter in the application, when it goes to GL, this entire combination is one account. Against that, you will have a debit, you will have a credit. So all transactions that we enter in the system relate to a ledger. Ledger consists of four things: calendar, currency, chart of accounts, convention. Calendar consists of periods, usually monthly. Currency, main currency of transaction is called as the base currency or primary currency, also called as the functional currency. Other currencies, there might be multiple currencies. Remember, most organizations nowadays are global organizations. So your company, or you look at Infosys, TCS, Tata Motors, Tata Steel, they are all multinationals now. They are operating in different geographies with different currencies. So those currencies are that can be called as transaction currencies. Then you have the chart of accounts, which is the list of all the segments and their values. So account code, it's a company, lines of business, then your cost centers or your intercompany accounts. These are all your segments that you can have. Against each of those segments, you will be recording your accounting transaction. Then you have convention. Convention is your accounting method. What did we say? What are the two main accounting methods? One is cash, one is accrual. So you'll have to choose between cash and accrual. So once again, I'm repeating, ledger consists of four things: calendar, currency, chart of accounts, accounting method, also known as convention. So, four C's: calendar, currency, chart of accounts, convention. Calendar, currency, chart of accounts, convention. This is the fundamental thing in the entire application. Once you get this correct, everything will fall in place.